it's an eventful year for equity markets, and at the end of the year, it's very interesting to get this note from BofA Securities, and which is why it's an absolute delight to welcome in Amish Shah, Head of India Research at BofA Global Research, who joins in right now on the show to talk about how he sees calendar year 26 after what, as I said, has been an eventful 2025. Amish, great having you. Thanks for joining in. Thanks for taking the time out. And, you know, it's an interesting note because I've known you to be a numbers guy, fairly conservative. And after a long time, in your note, I've picked up 2 or 3 hints of optimism, if I'm not wrong, because you say that risks are skewed to the upside based on potential reforms, likely FII outflow reversal, and the events calendar. Am I stretching it too much when I say that you're sounding a bit optimistic?
Morning, Neeraj. Thank you for inviting me. No, so you're not wrong. I would argue that for the last 1 year, call it from August of last year up until now, we were not that excited about markets. We did think that from the September highs that we saw last year, we thought that markets are at best going to give flat returns. By November, when we had put out our year-ahead note for 2025, we were arguing for around 10% returns, which is where we have landed this year to be. So last year was not looking at that. Last year, when we put out the year-ahead note for calendar 25, it was not looking that exciting. Now, I would argue at least that we are talking about an 11% upside, which arguably is not very high, but at least there is an upside to talk about. And you are right, we do think that the visibility of this upside is more certain with the risk skewed to the upside this time.
Okay. Amish, you got the handle on, amongst everything else, all the numbers that you did, but on the color of or the texture of flows, very, very spot on. And I read in your note that you're saying that there is a likely FII outflows reversal happening. What is the basis for this? I want to start off with the non-number conversation. Is it based on earnings growth that could bring about this, or does it need to have a semblance of the trade deal also weaved in?
So trade deal is definitely important, and that could lead to, in fact, FII inflows. But at least to make a call on FII outflows stopping now, I do think that that is going to be driven by global factors. So generally, you would see historically that when dollar depreciates and when Fed cuts rates, you typically get flows in favor of EM because clearly investors globally in a lower rate environment try to look for opportunities outside in the EMs to chase better returns, both of which we think is going to be the case next year. There will be Fed cuts, there will be some dollar depreciation. So that's number one. Number two, FII flows is also going to be dependent on what is the math that you can make on from an asset class perspective. So let's say when the US bond yields were quite high, one could argue that, higher 10-year bond yields plus the rupee depreciation risk that you're taking plus the equity risk premium, unless that number does not add up to 11-12% returns visibility, FII flows may be away. But now this time it looks like that the math is turning favorable in favor of India. And then finally, to your point, earnings will help, which is another point that we are making, that at least the earnings cuts in India is now moderating or is going to moderate. And incrementally, we think that earnings growth can accelerate.
Amish, hi, Tamanna here, and great speaking with you as always. In your note, apart from all of the optimism that you and Neeraj have spoken about, you do mention downside risks, and one of them caught my eye, which is the delay in the US-India trade deal. I think of all the downside risks you've mentioned, that one seems one which is present and looming large. How much of a downside risk is it in your view? Because we've now been without a trade deal for several months.
So Tamanna, you're very right. At the same time, I would say that from a markets perspective, markets have completely priced in that the trade deal is going through. So markets have also priced in that the tariffs will probably be somewhere lower than 25, because 50 coming down to 25 is a given from a market's perspective, given that we've already dialed down on Russian crude. but markets have also taken a view that 25 itself is quite high, and somewhere in the range of 16 to 25 is where the eventual tariffs will be. So that's already priced in. Now, obviously, if there's a delay to the deal or if the deal does not happen, in that case, arguably the markets will have to reprice the fact that the tariffs are actually higher than what they had budgeted for, and is therefore a downside risk. And obviously, that also to some extent, while India's macro situation is very good at this point in time with low inflation and low fiscal deficit and so on and so forth, but it will at the margin or incrementally deteriorate current account. That could arguably lead to rupee depreciation problem. That then arguably can put a pause on the rate cuts that we are expecting in a base case, and so on and so forth. So the ripple effect of that deal not going through or getting delayed, I think, is not yet priced in the market, and it's a risk. It's not our base case, but it's definitely a risk. And we think that if that happens, it will be particularly more damaging for the small and mid caps as opposed to the large caps.
So then is the converse then less muted, because the market is already priced in the deal, as you said. So when it does eventually come through, do you think we'll have a slightly muted response?
Absolutely. So I think it also depends at what rate do we finalize. So if it is closer to 20% eventually, I think markets are hardly going to cheer. If it is closer to 15, 16, then I think there's a reason to be reason that the markets will celebrate. And in an event where the Supreme Court in the US in their proceedings argues that the Trump tariffs are illegal to begin with, then I would argue that the markets will be very optimistic, because then you come down to the baseline.
Yeah, so three scenarios that could play out over there. Amish, just coming into some of the specifics, one theme that is recurrent, I would say, end of 2025, and maybe we saw this last year as well, same time, is financials being one of the top sectors that are being liked, and large caps looking like they will outperform SMIDs. You're sticking with that?
Absolutely. So I think both these trends will recur. So Tamanna, first thinking about financials, first of all, I'm pretty sure that almost every guest on your show would have argued that the only sector where valuations are reasonable or make sense is financials. So it definitely comes across as a sector which is not outpriced. Point one. Secondly, all through this calendar year, for financials, it was about when will the earnings bottom, because as RBI kept on cutting rates, there was a concern around NIM compression, and as a result, while they were cheap, nobody wanted to still own them because you did not know where will the earnings bottom. But now with the RBI rate cuts being either more consensus or in the fag end, we do think that earnings will have found a bottom. In fact, on the back of lower rates, you will now see an acceleration of loan growth, and therefore as the growth expands in the financial space, and with the fact that valuations were always cheap to begin with, financials should do well.
Amish,
and on your second question on large caps outperforming...
Please continue. Please continue. Please finish your point.
So on Tamanna's second point on large caps over small and mid caps, so look, I would say that the growth premium of small and mid caps over the last 5 years was extremely high. So small and mid caps delivered around 500 basis points of extra growth over and above the large caps, and therefore they deserve to be trading at a valuation premium. As we go into the future over the next 2 years, we think that that growth premium is going to shrink meaningfully, but the valuations on the other hand for small and mid caps have expanded in comparison to large caps. So that dichotomy we think means that while the small and mid cap companies also deliver growth, they will continue to see valuation contraction, and as a result the net upside is going to be marginal in comparison to what we are arguing in the case of large caps, which is about 11%.
Got it. But you see opportunities within the SMID space as well. I don't think I've seen this line in your notes in the last many months. So that was an interesting one. But also just dissecting that a bit further, you pointed out 2 or 3 themes, all of which have an export element predominantly to the US as well. IT, chemicals, jewelry. Very interesting.
So again, absolutely. So you're right. Earlier we were broad brush negative on everything small and mid caps. Now that some of these sectors have fallen anywhere between 20 to 50% correction, we do think that in some pockets there are at least opportunities. So primarily we think that within the small and mid cap space, there are some companies within financials, IT, chemicals, consumer durables, hotels, so there are at least, and jewelry, as you said, so there are some sectors where we think that the correction is now quite meaningful, and there might be opportunities to bottom fish on these stocks. Particularly on your question on them being export-led and catering to the US. So as I said, that our base case is that the deal will go through. Maybe the timing is when we can debate. So our base case is not that the deal will fall apart. So that's point one. Secondly, taking that argument forward. So last year we were generally bearish anything which was exposed to the external world. So we were bearish IT, we were bearish pharma, steel, energy, upstream energy primarily. So we were bearish broadly everything which was globally exposed, because we thought that the visibility of growth is more from domestic-led sectors. This time around, we do think that certain sectors which are globally exposed, we like. So we have turned positive on pharma, because the risk of generic pharma getting tariffed is extremely low, point one. Point two, there were worries about Remlevid eating into the earnings, which we think is now going to be an issue which will be behind after the December quarter earnings. From there on, markets will focus on what are the alternative growth areas for the generic pharma companies. So there are some, we were positive on aluminum, we are still positive on aluminum. So there are some globally focused sectors or external focused sectors that we are now bullish on as well.
Amish, wondering how you're feeling about platform companies. Some there and have done well this year, others entering through the primary markets and will be part of the choices that investors have. Do you look at them as opportunity for alpha, or where some of the cream has already been taken off before they've come to the secondary market?
So Tamanna, again, there we are quite bottom up. So I would not say that we are broadly positive on internet. There are some pockets of internet that we are positive. Primarily we are positive on quick commerce. We are positive on travel booking portals. So some bottom up themes where the growth visibility is high. We are optimistic, but we are at the same time, we are not optimistic on fintech, the consumer tech primarily kind of companies. So there is a bunch that we are positive, there is a bunch that we are bearish. So I think internet for us is more bottom up.
Okay. Thank you so much, Amish, for speaking with us. As we look at our outlook for 2026, we're getting you different voices through the rest of December as we go along. And this was from Bank of America, Amish Shah speaking on.